I look for founders that have grit, came from nothing. It's EQ, it's sales skills, it's persistence. That's the stuff that matters. People that are hustlers, dogged, are very responsive. People that respond back to emails or text really quickly. People that are always on. People that show gratitude. Founders who have chips on their shoulder, who want to prove the world wrong.
Welcome to another episode of Outsider Inc. I'm your host, Ian Hathaway. Today's guest is Mitchell Green, co-founder and managing partner of Hedge Capital, a growth equity firm managing roughly $9 billion and one of the most unconventional investors of his generation. Mitchell's story doesn't start in a boardroom. It starts in Grand Rapids, Michigan. A father running a generations-old family manufacturing company and a kid juggling 3 paper routes by 6th grade. At 18, he was working the factory floor of the family business, an experience that gave him a respect for ordinary work and a perspective on how hard most people's jobs really are. He skied his way into Williams College, dropped out to start a company, failed completely, and begged his way back in. Then, he found the seat that changed everything, Bessemer Venture Partners, where he became one of the first 2 cold callers the firm ever hired. 2 years, tens of thousands of voicemails and emails, and 1 essential education. When the financial crisis hit in 2008, Mitchell did something almost nobody would. He bought investments out of a struggling hedge fund, passed the hat among Williams trustees, classmates' parents, and CEOs he'd once cold called, and started doing deals on his own. One of his early LPs finally told him to raise a real fund. So in 2011, he did. $52 million, anchored by a now legendary investment in Alibaba that most people thought was crazy. 15 years later, Hedge looks like nothing else in the industry. A rigid set of 8 criteria that filters 9,000 companies a year down to a handful of deals. A willingness to buy into great companies any way possible. Leading rounds, buying LPs out of decades-old funds, outright buyouts of profitable, bootstrapped software businesses the coastal venture world ignores. And the engine underneath it all? More than 800 operator and executive LPs who don't just write checks. They open doors. The founders Mitchell backs look a lot like he once did. Gritty, persistent, underdogs with chips on their shoulders. People who respond to every email, never stop pushing, and want to prove the world wrong. He doesn't care where they're building or what pedigree they carry, and today, only about 10% of the portfolio sits in the Bay Area, and more than half the time, Hedge is the first institutional money in. Mitchell was underestimated at nearly every turn, and then built a firm whose entire model is finding the companies and the people most others overlook. In this episode, I want to explore what he sees that the rest of the market misses. Mitchell, welcome to Outsider Inc.
Sure, thanks for having me in.
It's good to see you again. Thanks for being here. The conventional wisdom in venture is that all the best deals come from certain kinds of networks, certain geographies, certain product categories, certain founder pedigrees. You built a $9 billion firm almost ignoring that entirely, finding durable companies before they're obvious, usually outside the valley. One of the core ideas of this show is that some of the most enduring companies get built by people and in places the market overlooks at first. Your own story fits that pattern as much as any guest we've had. So I'd like to start with something philosophical. When everyone's chasing the obvious and the glamorous, what lets you look at a blind spot and instead see an opportunity?
So I was like a nationally ranked ski racer growing up, and I'm not afraid of taking risks. And I've never been part of the cool crowd, or I've definitely never been referred to as cool in my life. Definitely not by my children, and definitely not in school. And I believe you got to look under rocks to find diamonds. By the way, I should have done some of the obvious things like SpaceX is probably only going to cost us not investing there at 30 billion, 50 billion, 100 billion, 200 billion probably costs us only $1 billion personally. Sometimes you can be very wrong, even when the crowd is right.
Okay, let's rewind all the way. You grew up in Grand Rapids, Michigan. Your father ran a generations old family manufacturing company, and you were entrepreneurial early. 3 paper routes by 6th grade. Your mother helped out. And at 18, you went to work on the factory floor of the family business. I have to imagine that you were probably the only kid at Williams who had ever done that kind of thing. That environment you grew up in, real businesses, real margins, the factory floor, what did it teach you about work, about money, about ownership, maybe even before you had a language for that kind of stuff? And then do you still look for that type of thing in founders today?
Yeah, I look for founders that have grit, came from nothing. I only got into Williams because I could ski race down a hill fast. I had the valedictorian from my school in my class, and me got in. And I'm pretty sure the counselor was more surprised than I was, actually. And oh, by the way, the great thing for me is I'm not that smart. Going forward, it's EQ, it's sales skills, it's persistence. That's the stuff that matters. So honestly, I think what working on the factory floor actually helped me understand the most is that there's a lot of people that work in regular jobs across America, whether they're bank tellers or working on a factory floor, who, because of inflation, which is like the silent killer, their lives are worse today than they were in 2000
Yeah,
on a real dollars basis. And I think that really pisses people off. But I think you just realize no matter how hard a day you think you had, try to go do the same thing repetitively over and over for every day, third shift. Your job's not that hard. Your life's not that hard. It's just perspective when you think you're having like a tough day.
I agree with that perspective. I grew up outside of Dayton, Ohio. Feel like as I've spent most of my adult life on the coast, having that perspective that a lot of people don't, it has forced me to look at companies and founders in a different way as well. Speaking of founders and that Williams era, I know you actually left school to start a company.
I did totally failed.
Yeah, tell us about that. What did that teach you? What lessons from that failure are still with you today?
Oh, yeah. So it's funny. When I failed, the chair of the economics department, who I co-founded the company with, Ralph Bradford, said to me, he said, Mitchell, you're going to be so successful. You have no idea. And I'm like, what are you talking about? He's like, don't worry. I'm telling you, you're going to be successful. I've been a professor for a long time. I've watched tons of students. And so what did I learn? I learned networking. I reached out to wealthy alumni. I never met these people. I cold emailed them. And then I cold emailed them again when they didn't respond. And like most of the time, people would respond. Now, a lot of times they'd say no, but life is a game of persistence. And the more persistent you are, the better. I learned if you connect people together, if you connect person A and person B together, two people that don't know each other, and then they become friends, those two people will help you for the rest of your life. And if you're constantly doing that, you basically get a whole large group of people that are like on your side rooting for you. That's probably like the biggest lesson learned. I started a software company. The whole idea was when you show up at Amazon's website, they know who you are and they can sell products to you in a one-to-one way. And so if my wife shows up at Amazon and I show up at Amazon, we see two different websites because they know the purchasing patterns. When you walk into Neiman Marcus or something like that, if you're somebody that spends a lot of money there, there's a salesperson with like a black book that knows everything about you. I know you have that pink shirt. These black pants we have, you should like try it on. It's how they get people that spend a bunch of money to spend more money. If you get your top 10% of customers to spend 10% more, it drives like 40% or more profit. It's crazy the amount by just targeting your top customers. But if you walk into Home Depot or Lowe's or Walmart, they have no idea who you are. But actually, they should because they have all the data on you. And so we built a system that was going to use a wireless device to basically identify you when you walked into brick and mortar stores so they could market to you in like one-to-one ways. Problem with the whole thing is twofold. One, selling to retail is like really freaking hard. They have really low margins. It's much easier to sell to biotech and pharma companies or tech companies that have 90% gross margins. Two, we were doing this in 2004. So we were doing it with Palm Pilots and Bluetooth. Like the idea now, you could just actually walk in and geofence a store. You actually wouldn't even need any infrastructure inside the store. But clearly that was not happening. Completely failed.
Well, timing's everything. Sounds like you learned maybe some markets to stay away from. You actually begged to get back into school. It worked out. After a short stint in banking, you found your way to Bessemer through an online posting, helped by a referral from Pete Wilmot, a Williams alum who mentored you and backed your college startup. At Bessemer, you and Brian Nieder were the first two cold callers the firm ever hired. You spent 2 years there making an insane amount of cold calls, voicemails, emails. well into the tens of thousands. So, my question is, what did those years on the phone teach you that you couldn't have gotten from a traditional venture apprenticeship?
Bessemer Venture Partners was an early stage venture fund. And this was like a Shark Tank firm. Every year, 500 entrepreneurs would walk in the door. They back 10 of them a year, move on to the next one. The people that ran that firm were good friends with the people who ran Insight. And they would say, why is Insight just done this deal in Omaha, Nebraska, or Kansas City, or St. Louis? Why do we not see it? And we're Bessemer. We have all these like world-class returns. And what they realized is all that Insight was doing was hiring 22 to 24-year-olds, pounding the phones at the time, leaving voicemails and sending emails. And if the company calls you back, literally hang up the phone. It's a CEO you call every 2 days for a month. That's the CEO you want to talk to. And so all they were doing was replicating what Summit and TA did. So when we joined Bessemer, they put us in front of a phone. They're like, listen, you're our guinea pigs. We have this great track record, but we've never gone outbound. So we were their outbound sales org. So when I took the job and I told my dad what I was doing, his literal response to me is, you're one of these idiots. And he's like, you better figure out how to add value or you look like everyone else. So what I would do is if I was calling the CEO of a company in Columbus, Ohio, and it turned out it was 25 million in revenue, and then I talked to another company that was like 40 million in revenue in Cleveland, I would connect the two of them together. Be like, hey, you guys both run software companies, or you both run tech companies. You don't know each other. You probably deal with the same kind of like challenges in running your business. You should know each other. So I built relationships with tons of people. And nobody had ever introduced two people would get like mad at you. And I was like, oh, thanks so much. 98% of the time, both people would thank you. Be like, oh, that'd be great. What we really learned though is you know what a good company is by talking to 10,000 bad companies. If you do something enough, if you're a professional baseball player, like Ted Williams could have hit a ball an inch off the ground, and maybe it was the longest home run he ever hit. But if he did that all the time, he wouldn't be in the major leagues very long. And he became one of the best hitters ever because he just knew in the strike zone where to swing. And it was all about probabilities and statistics.
Good lessons. I wrote down all these things: persistence, finding opportunities where others aren't looking, looking for ways to provide value to people, and building relationships by connecting people. That phone bank education got tested fast because by 2009, the financial world had come apart. You had moved on from Bessemer to a hedge fund. And that February, the founder of Bizarre Voice called, offering you a chance to invest. Scraped together, I don't know, 8 or 10 million from a few dozen people, Williams trustees, CEOs you had cold called, classmates with wealthy parents. Later, Jim Schneider, Dell's former CFO and one of those early LPs, told you to stop doing one off deals and to raise a real fund. So in 2010 and 11, you went out and did that. You raised 52 million, anchored by an Alibaba investment. That deal ended up returning about $1 billion and put you on the map. Talk to me about that time period and the sequence of events.
Which, by the way, a lot of people then didn't want to invest in because they're like, it's China. It's going to be worthless. And so, like, who I owe my career to is one, Jeremy Levine for hiring me at Bessemer Venture Partners, gave me the tools and skill set to be able to be a good investor. Two, Scott Booth hired me at the hedge fund seated by Julian Robertson called Eastern Advisors. He hired me. He saw something in me. A bunch of people had said no. And he hired me and gave me the rope and freedom to go do something. And I made a couple private investments for him. The hedge fund then didn't do well in 08. I bought the investments out of the hedge fund. Most people would have just like left. And I was like, no, I want to buy these out. And I raised the money by literally raising chunks from like 25 grand from friends to like 500 grand or $1 million. And I raised 10 million bucks to start, probably from 100 people, 50 people. Then Bizarre Voice worked. So I owe Brett Hurt, the founder of Bizarre Voice and CEO, built a huge business, took it public. We made great return. And by the way, I started helping the company a bunch. Like I was making those intros for him. And I had known Brett through cold calling him at Bessemer. That's where I first met him. It was not a Bessemer company. I just got to know him and made a bunch of intros for him. And so we stayed in touch. He happened to go to Wharton when he was at campus. One day he like reached out to me and I told him I was leaving Bessemer. And so we got together and I said, look, I'm working for this fund. Any chance we can put a little bit of money in? We don't need to own 25% of your business. And we put a little bit of money into the hedge fund, and then the hedge fund had a bad year. And so we had to get liquidity at the hedge fund. I bought it out. And then I started helping them a bunch. I'd be like, hey, I'm going to ask our LPs, You say you want to enter a Procter& and Gamble. Well, let's ask the 100 people who are invested with us if anybody's anybody at Procter& and Gamble.
Sounds like early shades of what has become your most distinctive asset, an LP base of executives who don't just write checks, but who actually do work. Was that the first time that you kind of thought of this as like, hey, these are capital allocators, but really that you could build an entire firm with this infrastructure of network? Walk me through that arc from passing the hat for capital to deciding that the LP base itself was the product.
In April of 2008, I'm working for the hedge fund while I'm at business school. The founder of the hedge fund, Scott's like, hey, Mitchell, we're going to like the Vegas Goldman Internet Summit. I'm like, what's that? He's like, oh, we're going to go meet a bunch of like public company CEOs and CFOs. And in one of the meetings, I was sitting with like the CFO of Expedia or Orbitz. I can't remember. And at the end, I went up to the CFO and he's like, hey, there's this company you should like meet. I said, I'm not an investor. But why? You should meet this company. I remember they did tons of stuff in the travel space and it was Bazaar Boys. I think probably a week before I'd just seen Brett or something. And I connected them. And I was like, wait a second. I could probably use the hedge fund network, the public equities network, to go meet CFOs and make like introductions to private companies. So I pitched that to like the founder of the hedge fund. He was like, oh, what company do you want to do it to first? I'm like, well, this company I've known forever. He's like, sure, I've done some private stuff. He had first invested in Alibaba in 2004. So we put some money in from the hedge fund into Bazaar Voice, and I just started helping him a bunch. And then when the hedge fund went south in '08, I bought the hedge fund out. But then I'm like, well, if ABC persons invested in this company through me in my vehicle, they're really invested in Bazaar Voice because it's the only thing in the vehicle. So I don't know, like, why don't I just ask them for help? Hey, XYZ investors, Bazaar Voice is looking for a CFO. Do you know anybody? And so just asked. And I kept asking again. And then after doing a couple SPVs, Jim, the former CFO of Dell, he calls me, he's like, dude, I've been in tons of funds. Nobody ever asked for help the way you do. And then I'd like self-report back on it. I'd be like, oh, hey, thanks so much, XYZ person, for the intro to GE or Procter& and Gamble or the NFL Network. We really appreciate it. And then a month later, they'd signed up as a customer. So it like reinforced it. It was like almost like game theory. And then after doing that second SPV, Jim was like, Mitchell, like, stop screwing around. You should raise a fund. What you're doing is truly different. So we raised our first fund and I called a guy. He used to work with him. I didn't know him when I was at Bessemer, but when he joined Bessemer, he pinged me. And he's like, dude, I just joined. I heard you're like a machine as an analyst, cold calling. So we got together and I asked him, like, hey, do you know anybody that would want to come work with me and start a fund? Nime was at Insight. I'd been there for a couple of years and joined. And I was like, hey, if you're any good, you'll be a partner at the end of fund one. So I owe my career to Scott from the hedge fund, Brett from Bazaar Voice, and Nime, my first partner. And then in the middle of fund one, I finally convinced my partner, Brian, who had been at Bessemer with me. And the three of us have run the IC ever since. And God bless 15 years of low interest rates and a bull market.
Obviously, there's been key influential people in your life along the way, but really it's about just out hustling people. Maybe you've been underestimated at times, right? The factory kid at Williams, the bottom bucket analyst, the cold caller, the guy raising a fund that nobody asked for in the rubble of the great financial crisis. A lot of what this podcast is about is founders who built great companies they were overlooked for a variety of reasons. They were building in the wrong city. They were building in the wrong product category. They didn't have the right networks, but you went out and succeeded anyway through sheer persistence and ingenuity. So is that your biggest advantage? And then secondly, is that something that you specifically look for in founders that other people might walk right past?
100%. Probably the most important thing is persistence, that like anybody could take to anything. There's lots of smart people in the world. I'm frankly not that smart, but I'll outwork anybody. And so like what we look for in founders are like people that are persistent, hustlers, dogged, are very responsive, people that respond back to emails or texts really quickly, people that are like always on, people that like show gratitude. We also look for that in employees too. Like people that were college athletes are amazing analysts because don't tell me that getting a C or D on a test is your biggest failure in life. Like, give me a break. Dropping the ball at the Rose Bowl, that's like a pretty big deal. Missing the Olympics because you got sick the day before, that's like real adversity. And if you could get good grades, be a world-class athlete in college, those are the type of people who want, or be an entrepreneur, be a world-class musician or whatever, something like just do a couple things and do them really well. But I think we are looking for founders who have chips on their shoulder, who want to prove the world wrong. My partner, Brian, used to call up Travis Kalanick at his old company and like said no to him. He's like, Travis called me back 10 times trying to convince me to invest over like a 6 month or 12-month period after that. And the other guy was Evan Williams, I think at Odeo, which became Twitter. He's like, I had called them, we passed on it, and they refused to let me say no. Both of those guys are multi-billionaires. So there is something to this persistence, just never giving up.
Well, it's funny that you point to two Silicon Valley companies because your firm is not really a Silicon Valley firm. Just around 10% or so of your portfolio is based in the Valley, which is pretty low considering that you invest in software. Is that by design or is it something else?
We'll look everywhere. We don't care. Look, there's persistent people everywhere. I first met Chris Friedland, biggest internet toilet salesman on the planet. He built a business called Build Improvement Direct, which became Build.com, which was like an online plumbing distribution business. It was in Chico, California. And Chico was in the middle of nowhere, to be clear. He sold it to Ferguson, which is owned by Wolseley, the big plumbing distribution business. And they built it into a multi-billion-dollar business. He stayed there for a very long time. LP of mine since my first SVB. And I reached out to him because of a cold call. The world is small. You never know what people will build.
Well, so you talked about what you look for in founders. You hinted at it earlier. You have this 8 criteria that is really a filtering mechanism for the types of companies you'll even take a look at. And then there's this shift that did occur somewhere along the way where you had some successful early stage investments, but primarily it's now only later stage growth equity and even buyout. Talk to me a little bit about the Lead Edge 8 and how the firm has evolved in its investment style over time.
So we've always had the criteria. Are you 10 million plus in revenue? Are you growing 25% a year top line revenue growth? Do you have 70% gross margins or higher? Are you profitable at the GAAP net income or EBITDA line? Are you recurring revenue? Do you have 90+% gross dollar retention? Do you have any customer over 10% of sales? And are you capital efficient? Are your revenues today greater than historical cash burn? And we're looking for like a 1-to-1 ratio or better. So are you 10 million in revenue? Have you burned less than 10 million historically to get there? We're looking for this like 1-to-1 ratio. Now, again, if it's 20 million in revenue, you've burned 3 million to get there. We can argue the market size is too small. We can argue that you're overpaying, but we can't argue you got like a bad business. If you're doing something right, you only spent 3 million to get there and you're doing 20 million in revenue. And if you have 80% gross margins, like you spent 3 to have 16 in gross profit, pretty good business. And by the way, I think like 7 of the 8 criteria were the same criteria we had when we launched the fund. We added capital efficiency, I think back in like 15 or 16. It used to be, you have to be 70% growth, but we said, look, let's do 25% growth because we balance out profitability as well. Fast forward today, we have almost 18, 22 to 24-year-olds that cold call companies on behalf of Lead Edge. And so our team speaks to about 9,000 companies a year. If I said you had to meet all 8 criteria, it'd be 1% or 90 companies. To do 5 to 7 deals a year, that's too small of a pond efficient. So we say you must meet 5. Just pick 5. Don't care. That's about a 10% yield. 9,000 companies, get to 900, due diligence on 150 to 175 of them to do 5 to 7 deals a year. And I would love it to be higher than 150 to 175, but again, they're not calling us. We're calling them or emailing them. And so we take this very flexible approach to just listen, we're calling the companies. Let's identify the company. And if the opportunity is to lead a round or to do the first round, because it's never raised money before because it's bootstrapped, who cares if we own 18% of a company or 76% of a company? Probably 2/3 of our deals are minority, a third is control. We've never actually put parameters around what those could be. It's all a random walk. But maybe that's not the opportunity. We'll buy LPs out of 20-year-old funds. If you own a fund that owns 30% of a company and I buy out half your LPs out of a 14-year-old fund, I just bought 15% of the company. It's the same thing. It's just a derivative. We've always done these sorts of deals, like funding co-investments, buying out LPs out of old funds, funding continuation vehicles. We were doing this before they were even called CVs. And so it's all about being creative. Some people describe us as hustlers. I just believe the number of great companies in the world that we want to invest in is not infinite, and you need to be super creative in how to get it. And look, we're trying to make 2 to 5 times our money in 3 to 7 years and not lose money. I'm not saying there's anything wrong with the venture power law business. This is not what we're in. We're not trying to make 50Xs Because if you're trying to make 50 X's, you're going to have a bunch of zeros along it, which is fine. It's just a completely different way to invest. We've had massive misses because we didn't go beneath the criteria. We've also saved ourselves a crazy amount of money by not swinging at wild pitches. SpaceX, when we looked at it, met 2 criteria. Now, again, it will cost us billions of dollars of gains, probably tens of billions of dollars of gains. And there's lots of examples like that. But I could also give you 300 other companies that we didn't invest in because of having this very rigid framework. In Fund 1, we led an investment in Refinery 29. It was 7 million of revenue. We wrote like a $3 million check and bought like 10% of the company or something like that. Today, we would just buy the entire business if it was that small a company. Because, we run a $3.5 billion fund, make 20 to 30 investments in it. We just invested in a business that'll do 750 million of revenues this year, up from 500. And that business, we wrote a $200 million check at like a $5.5 billion valuation. So we own like 4% of the company or something like that, right? Had we done it originally in Fund 1 with $50 million, we would have written a $3 million check and owned 0.0001% of the company. What's happened is in Fund 1, we had like 10 investments, roughly. Fund 6, we had 20 investments. So we doubled the number of companies. I think average ownership's gone from like 3.5% to 35% or something like that. There you go. That's how you go from 50 million to 2 billion.
So the check size, maybe stage evolution. Also, the type of company has changed. I read somewhere that, around 2/3 of your companies, you're the first institutional money in.
I think it's like 55% now. We're the first institutional money. It wasn't that much different in Fund 1. It's like a third. By the way, these special sits that we do, like buying LPs out of old funds. I mean, our biggest investment in Fund 1 was buying LPs out of a hedge fund side pocket to get access to Alibaba. Fund 4, we bought LPs out of an old fund to get access to Zoom. Unfortunately, we are pretty stupid because we sold it before COVID. We made something like 3 times our money, but we could have made 20 times our money. Oops. But it's always been, let's just fund the best companies at the best risk adjusted rewards and then like wrap the investment around the company.
You've written quarterly letters for 15 plus years, and one of them put forward a framework, the hierarchy of bullshit. It's this idea that when a founder can't lead with the strongest proof, they slide down towards softer, more flattering metrics that are less meaningful. You've said that thinking came straight out of cold calling thousands of companies and watching the different patterns. What are the tells that still reliably indicate that someone's dressing up weakness as momentum? And more importantly, has the spin gotten worse in this hot era of AI that we're currently operating in?
We are somewhere in a bubble, whether we are in 97 or 2000, I have no clue. But there's a lot of capital chasing things, and AI is going to revolutionize the world in ways we can't even think about. But just remember, in 99 and 2000, the word social media would never have been uttered had I been on here with you. It is today a $4 trillion market. Back then, we would have debated was Eat Toys and Pets.com and Boo.com and Amazon going to put out of business Walmart, Home Depot, Lowe's, Sears, Target, Montgomery Ward, Kmart. What actually happened? A couple of the new guys became gigantic. Most of the new guys failed in Gen 1. Then the over-levered incumbents busted because they couldn't innovate. Because if you've got too much debt, you're dead. And in any period of rapid technological change, if you can't innovate, your competitors are going to crush you or new companies are going to come along. A lot of the incumbents will do just fine. But again, the ones that are over-levered will be in trouble. And so we are definitely in a bubble time. I think Anthropic is an incredible business. It's an incredible product. But when I hear that people use open source at 1/10 the price to run inference, that scares me. And if I look at how fast Anthropic came onto the scene, could there be something else come along? Could the greatest money printing machine on earth, Google, flex their muscles? The winners today, I think people are just assuming that they will be the winners in 5 years or 10 years, and it could be very, very different.
Best guess today, how do you think this plays out?
It's going to revolutionize the world in ways that we can't even think about. It's going to be the world's greatest productivity boom. I mean, the idea that there's going to be less jobs is absolutely comical. I've yet to meet one person who's using AI to work less. I think we're actually going to be working more. And there's going to be incredible businesses that are built that are just now starting or haven't even started yet.
I think it's like all those technological revolutions, right?
Yeah, you overestimate the near term and you underestimate the long term, 100%. But I think it's going to be an amazing time. You're already seeing it, like new business creation has gotten faster. But I think people are going to create new whole categories that we're not even like thinking about right now. I'm not a healthcare investor, but what's going to happen in biotech and pharma? It is possible that you get cures to things like Alzheimer's and cancer and things like that because of advances in technology. I don't think the biggest advances in AI are going to come from the call center software. We are literally scratching the surface. You just need to come in like eyes wide open.
I want to shift gears a little bit to the personal. You've built a great life in Santa Barbara with your wife, Lisa, and your family. You race cars. You're involved with lots of interesting things and people, but you also travel constantly. You sleep 4 or 5 hours a night and you work all the time. You said that even after everything Lead Edge has become, the score still matters, right? You still want to win. That competitiveness has always been inside of you. It's always been a part of you. I know that you love your work, but what is the cost of maintaining that constant level of intensity?
I don't see my kids as much as I probably should. But I do see my kids probably a lot more than some other people do in the same positions as me. People will be like, oh, you're on vacation in Italy. And my wife would be like, no, no, we're in Italy. That doesn't mean he's on vacation because my husband doesn't know how to take vacation. He schedules calls 12 hours a day. He'd be on the racetrack and get out of a race car and 20 minutes later be on a conference call and get back in a race car and an hour later after a race be on a conference call again. But I like what I do. I want to make a lot of money. I've had that goal since I was 5 years old. I didn't want to change the world. I didn't want to become president. I just wanted to make a ton of money and have fun doing it. So the most important thing is if you want to make a ton of money, realize you can do it doing anything. So just pick something and do something that you're extremely passionate about because life is too short. I just had our controller of 15 years at 61 years old with an 11-year-old dropped dead of cancer.
Oh, shit.
He had it for 3 years. Like, it sucks. He had colon cancer that progressed to liver cancer. What did he do? Like most stubborn men, including myself, he probably had symptoms for 2.5 years. And they found it was stage 4 cancer, but he lived for 3 years after. So guess what? Go to Prenovo, get scanned, especially if you have the money to do it. Go get a physical every year. But like live life to the fullest because you might wake up and find out you have 2 years to live. I truly believe cherish your friendships, cherish your family, and just do what you love doing. Because I know so many people that work most of their careers and like hate what they do. Go start a company. It's never too late. Go start a business, become an entrepreneur, do something you like.
I want to end on legacy and mentorship. Pete Wilmot backed your college company when it was nothing and then vouched for you to get that Bessemer seat after it failed. And Lead Edge has basically institutionalized that access and capital and experience for founders who'd otherwise be overlooked by traditional VC. Jeremy Levine took a bet on you, maybe when others wouldn't have, Scott Booth as well. So did your partners, Nime and Brian. So when you think about legacy, how much of it for you is the returns, the companies, and the success? And how much of it is becoming for someone else what your mentors were for you?
It's a great question. And I just had Jerry pass away on this. So I've like thought about this stuff a lot more than I normally would. I've heard it being known as like, oh my God, was he a pain in the ass? Oh my God, was he like relentless? Did he like never give up and drive me insane? But like, oh my God, did he care? And was somebody that would have done anything for his friends or his family. And my God, was he passionate and truly worked harder than anybody? That's what I want to be known for. Somebody who did what they said they were going to do. So the way I mentor people is people email me and they'll be like, hey, I'm starting a fund. I saw you on Invest Like the Best. I saw you on your podcast. I saw you on CNBC. And I will respond to pretty much every email that I get. Sometimes I'll do like a 15-minute call with people. But if not, if I'm like, look, I'm just super busy the next month, ping me in 6 weeks. Okay, that gets rid of 90% of the people because they don't ping me in 6 weeks. But if they do ping me in 6 weeks, I'll be like, okay, great. Let's set up like a 15-minute call. I spent summers on the East Coast. Like, ping me if you're in New York or Long Island. Or come and see me in September in Santa Barbara. I'd be delighted to have coffee with you for half an hour. And then if that goes well, I'll say to the person, look, in 6 months, if you want to come back and have coffee with me again, breakfast, have at it. I can count the number of people that want to come and have coffee with me quarterly is 2 to 3. They all could have done it. Very few people do. And by the way, the same thing happens to me. There are a handful of people that I have as mentors that have been huge investment organizations that I regularly still talk to.
That's a great place to end, Mitchell. But before we go, we like to finish with a little segment we call Beyond the Bio. These are just some quick hit questions that let us step away from the resume and dig into what makes you you. So, what's a quick piece of advice from a mentor that stuck with you throughout your journey?
Hire people way smarter than you.
Who's an unsung hero in your life, and what has been the impact they've had on you?
Oh, my wife, for sure. My wife or my dad. My wife, just to like keep me very grounded and to realize my life is a gigantic vacation compared to my wife. She's like, I'm sorry, do you want to be home with 4 children all the time? When's the last time the hotel in New York screamed at you what was for breakfast?
Oh, that's excellent.
When I hear people say like, "Oh, my wife doesn't work," I'm like, "No, your wife works harder than you do." Moms are the most underappreciated people on planet Earth.
Yeah, 100%. Well, you've talked a little bit about racing, skiing. Tell us something else maybe people don't know about you. Something outside of work, like a hobby, travel spot, guilty pleasure, or maybe even a hidden talent.
Okay, I'll tell you something. If you take me to a bar, I'm very shy, actually. People will be like, "That's impossible. The guy's not shy." If you took me to a bar and said, like, go up and talk to somebody, I wouldn't do it. And it's the same as I was at 21 and the same as I was at 15. If I go to a conference in a room with 100 people, I will go sit in the corner. I'm amazing one-on-one or like two-on-one, like small group, but I still to this day cannot walk up to somebody in real life and start. It's a very hard thing for me to do.
What are one or two songs you'd like to add to our Spotify Founders playlist? Something you listen to at work, something that kind of motivates you.
So I listen to very eclectic music. My playlist includes Sabrina Carpenter, Genesis, Michael Jackson, Eric Priet, Cascadia, Kesha, Kygo, Addison Rae, Bon Jovi, Ed Sheeran, Sam Felt, Grateful Dead. I listen to everything. Depends the kind of mood. So if I'm about to get into a race car, I love listening to like AC/DC, Highway to Hell. It's like totally absurd.
All right, one last question. If you could give one piece of advice to someone who's about to start out on their founder's journey today, what would it be?
Don't give up. Listen to feedback. Write handwritten thank you notes.
That's a great way to end. Mitchell, thank you so much for being here. I really enjoyed this conversation. I hope you did too.
Thanks for having me on. I appreciate it.
That's a wrap for today's episode of Outsider Inc. A big thank you to Mitchell Green for joining us and sharing his incredible insights. What stays with me from this conversation isn't the $9 billion under management or the legendary Alibaba deal. It's how unglamorous the edge really is. 20,000 voicemails, connecting two strangers who'd thank you for the rest of their lives. Mitchell built one of the most distinctive firms in the industry, not by being the smartest guy in the room, as he would say, but by outworking everyone in it and by turning generosity into infrastructure. And underneath the relentlessness is real discipline, knowing your strike zone and having the patience to let the wild pitches go by. But the moment I keep coming back to is quieter, a friend gone too soon, and a man who's wanted to make money since he was 5, telling us the real ledger is friendships, family, and doing what you love. Because life is too short for anything else. So take Mitchell's advice, don't give up, listen to feedback, and write the handwritten thank you note. I can tell you firsthand, he does. If you want more from Outsider Inc., don't forget to subscribe to the platform at outsiderinc.substack.com. It's packed with highlights from today's episode and bonus insights you won't want to miss. You can follow Outsider Inc. on YouTube, Instagram, TikTok, and LinkedIn at Outsider Inc. Pod. You can also follow me on X at Ian Hathaway. Outsider Inc. is produced by Spellbinder Media. We'll be back soon with another fascinating outsider conversation. Until then, thank you so much for listening. And remember, great entrepreneurs can come from anywhere. See you next time.